Okay, so now we are going to study a concept of NPV, which stands for net present value. It is the advanced investment appraisal technique, and it is one of the important area from your financial management syllabus, and you can expect a question or any part of question from this topic. So in other words, it's an important topic. But before starting this topic, let's recap what we studied earlier. So we will have a quick recap of that. Okay, so here we have company, and we know that the shareholders of the company invest into the company, and because they invest into the company, so they expect return because they have invested into the company. On the other hand, we have directors or the managers of the company who act on the behalf of shareholders to work in the best interest of them. So, as their primary duty is the responsibility of director to increase the wealth of shareholders. So we have studied the concept of wealth maximization in our previous lectures, where we talked about what is the difference between wealth maximization and profit maximization. Anyhow, it's the responsibility of directors to increase the wealth of shareholders of the company. Now, the shareholders of the company can expect this return in two ways. For example, they can expect it in the form of annual dividends. They may also expect it in the form of capital gain. Now, coming back, as we know, the shareholders of the company do not involve into the day-to-day matters of the company, and it's the responsibility of directors to act in the best interest of shareholders. So, if the directors of the company perform well, then in that case, we can expect more profits. So if the profits of the company is good, then the shareholders can also expect high dividend. But if the director's performance is not good and the profits are not adequate, then directors of the company may decide either to give low dividends, or they may also decide to give zero dividend to shareholders if they think that the profits are not adequate. So, as we know that the shareholders of the company are the owners of the company, but this dividends policy is in the hand of directors. So, if the directors want, they may give dividends to the shareholders, and the directors may also take a decision to give zero dividend to shareholders for any specific year, and they cannot do anything. Right now, I am specifically talking about these dividend policies. But on the other hand, if the director's performance is not good, then the shareholders of the company may also decide to fire them and rehire some good directors. But it's not the topic of today. So, as we were talking that shareholders of the company expect some return because they invested into the company. So, another form of return is capital gain. For example, if the share price of the shareholders share price increased. In that case, we call it capital gain. But if the share price decreased, then in that case, we call it capital loss. So if the share price will fall, then we will call it capital loss. These are simple conceptual things that we see in our routine life. So I am telling these things so that we can link it with our further or future topics and you can understand them in more simpler way. Okay, so one more thing, if I talk about any company, then we know that without cash, no company can operate its operations. So there can be two sources of this cash which can come into this company. The first source is, we have already seen it, these are shareholders of the company, and the second source can be debt or loan, and this source is known as equity. Okay, so now we are going to see some more details related to these two sources of finance. Okay, okay, so we know that there are two sources of capital. The first source is equity, and the other source is debt. Okay, so now we know that we can get finance from either of these two sources, but there is always a cost related to capital, no matter either you are taking capital from equity or either your company is taking capital from debt. There is always a cost related to it, and we will see and study it shortly. So we are going to discuss cost of capital. So in this case, the company get finance internally, and in this case the company get its finance externally. So in this case we will talk about cost of equity, which is sometimes also denoted as KE, while in this case we will talk about cost of debt and we denote it as KD. So here the K represent cost and E represent equity. Again the K represent cost and D represent debt. So in this case, if the company get investment from equity, then in this case the capital or money belongs to the owners of the company. But in this case, the company borrow finance from any external source such as banks, etc. Now let's say the company take finance from debt. Then in that case, the company will have to pay compulsory interest. Now we can assume that, let's say, the interest which the banks are charging from us is, let's say, 5%. But after a few months or after a year, the banks increased this interest rate. Now let's say it is increased to 6% or 7%. Now what will happen? You were paying interest 5% before, but now you will have to pay 6% because the banks have increased the interest rate. So in the case of debt, what is your cost? Obviously this debt which you have to pay compulsory, right? So in the case of debt, your cost is cost of capital is interest rate. But in this case, we are not required to pay anything like as we were required to pay in the case of banks, right? No, basically wrong. So as we studied earlier, because the shareholders of the company invest into the company, so because of their investment, they expect some return, and they expect that either the company make profit or loss, they should be given some minimum return, and we see that it can be given in the form of dividend or capital gain. So they expect some minimum return because they are investing into the company. So this minimum return is also known as required rate of return, because in this case, in the case of equity, the shareholders are suffering with opportunity cost. Now what is the opportunity cost in this scenario? So basically they have invested some amount into your company, and now they cannot invest that amount which they have already invested into your company into any other project. So that's why they are suffering with an opportunity cost. For example, the cost of not investing that money into anything else. So it means we have cost related to both of these sources. So even though your company is getting finance from any internal source, even then this finance is not free, and we have some cost related to both of these sources. Okay, so now we are going to discuss a very important point. As now we know that it doesn't matter from which source we are getting finance, there is always some cost associated with it. But in the case of debt, our cost of capital will always be low. And in the case of equity, our cost of capital will always be high. So in this case, our cost will always be low, but in this case, our cost of capital will always be higher. Now the question is, why is that? So if I give you an answer in a simple word, then I can say that it's because of risk. In this case, we have low risk But in this case, the investors or the shareholders of the company suffered with high risk. But in this case, the risk associated is low. Now, how the risk is low in the case of debt and how the risk is high in the case of equity, it's another question. Now, in this case, the company have to pay compulsory interest. Doesn't matter if the company is making profit or loss, company have to pay this interest at any cost. But here in the case of equity, the situation is not same. Like as we studied earlier, it's up to the decision of directors of the company. They may either give dividend to the shareholders. The directors may also decide to give zero dividend in any specific year in case if the company is making less profit. So in simple terms, we can also say that it's not compulsory on the company to give dividends to their shareholders annually. But in case if the company decide to give dividend to the shareholders, then it's also subject to the decision of directors of the company that how much dividend should be given to them. Now you can see that in the case of shareholders, the risk is high, while in the case of debt, the risk is low because the company have to pay compulsory interest at every year, no matter if the company is making profit or loss. One more thing, banks or an external party from which the company is taking loan, they can secure their loan or debt amount against the company's asset. So in case if the company is in cash flows or liquidity problems, then in that case these banks or an external party from which the company has taken loan, they can sell the assets of the company to recover their loan amount. But there is no such a facility is available in the case of shareholders of the company. So again they are taking more risk. So because they are taking more risk, that's why they expect high return, and that's why the cost is high. Cost of capital is high in the case of equity, and the cost of capital is low in the case of debt. So now we know that debt is a cheaper source of capital. So based on it, we can also say that a company should take 100% debt to minimize its cost. Right? Again wrong. Now you may have a question why. Now to answer it, we will study a topic and its name is WACC, weighted average cost of capital, later in this course. Okay, so we have few more things after which we will start the topic of NPV. Okay, so this required rate of return is also known as expected rate of return. We call it expected rate of return because it's not the actual rate of return. The actual rate of return can be different from what we are expecting, right? So this required rate of return is always expected rate of return. Okay, so now we have one more question, that why it's necessary to keep the shareholders of the company happy. Now let's say if the shareholders of the company are not happy, then in that case the old shareholders can simply sell their shares to someone else who will become the new shareholders of your company. Then why it's necessary to keep them happy? So the simple answer is, if your shareholders are happy, then in that case the share price of the company will go up. But in this case the share price of the company will go down. Fine. So it's necessary to keep the shareholders of the company happy so the share price of the company can increase. Okay, so just a last thing after which we will start our topic of NPV. We have techniques to calculate these cost of equity or either the cost of capital. Let's say in the cost of equity we have two models. The one is known as DVM, dividend valuation model, and the other one is known as CAPM or CAPM, capital asset pricing model. By the way, the person who created this model was awarded with a Nobel Prize. Anyhow, the purpose of telling you about this is to inform you that there are separate techniques to compute cost of equity and cost of debt. So now let's start our topic of NPV. This method is very useful and it tells us the impact of investment on shareholders' wealth, net present value, and it tells us the impact of investment on the shareholders' wealth. Now, if I talk about it in very simple words, then we have some discounted cash inflows, right? And we compare it with some discounted cash outflows which we expect during the life of project. And here is the net result, which is our answer. It can be either positive or negative. Now let's say if the result is positive and inflows are higher, the inflows here are higher, then in that case we will accept the project. But in the case if the outflows of the company is higher, then in that case we will simply reject it. And there can be a situation where the inflows of the companies and outflows are equal. Fine. In that case it is also mostly in most of the cases it's not advisable to go with such a project. Now let's say if the company have more than one projects, like project number 1, 2, 3, and so on, then the company should choose such a project whose NPV is higher. Okay, so now we have some underlying assumptions related to NPV. The assumption number one is all cash flows occurs either at the start of year or at the end of year. We also assume that the initial investment occurs at year 0, which is denoted by TO. It is not 2, it is 0. Okay, and the other cash flows or the rest of cash flows start in the next year, for example in the year after this. So the other assumption is other cash flows start 1 year after the initial investment, and which is denoted as T1. Okay, so we have a important note here that never include the interest payments within the NPV calculation because these are taken account by the cost of capital. So while you are calculating NPV, why to include interest payments? So these were some important things. Now we will go to the illustration related to NPV so you can understand it better.